Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very green day across the board. Mega caps rallied, the market rallied, and the market is pricing in optimism that the Fed's jumbo interest rate cut of 50 basis points yesterday is going to deliver a soft landing, and we definitely saw a return to risk on. Look at stuff like consumer staples, utilities, as well as healthcare. Very mixed in those sectors, and stuff like utilities and consumer defensives actually very red. Cyclical sectors, stuff like technology was very green. Nvidia up 4.14%, Microsoft 1.7%, Apple 3.85%, Meta a new all-time high 4.07% today. PayPal and credit services excluding MasterCard and Visa did very well. PayPal was up 6% today. Extremely bullish day, and pretty much the market is sort of realizing that a deep cut is sort of going to fend off recession risk, and when the market doesn't go into a recession and we get rate cuts, the stocks do very well, and that's ultimately what the market was telling us today. 50 basis points of cuts yesterday was probably the right move. We actually saw the worst performing sectors being real estate, staples, utilities, healthcare. So pretty much these defensive sectors, technology, consumer discretionary, and industrials, these highly sensitive and cyclical stocks were the best performing indices. So it was pretty much risk on and risk on for growth, but not just in large caps, small caps too, and mid caps actually. Everywhere across the spectrum, excluding value, we actually saw like a blockbuster rally. At this point, it doesn't even matter what segment or what factor outperforms the other. When large size is up 2.5%, core is up 1.6%, small growth is up 2.4%. No matter where you are positioned, you did very well as long as you were in growth and core across the size segment. And traders also got some validation that the Fed was engineering a soft landing for the economy when weekly jobless claims fell 12,000 against the market forecast. We were expected to get 229,000. The actual number came in at 219,000. At the same time, fully fed manufacturing came in better than expected. Existing home sales, while it did miss, was pretty much in line. 3.86 million versus 3.9. That's pretty much an inline figure. And then the US leading economic indicators came in better than expected as well. Less of a decline. And upbeat data coupled with Fed rate cut yesterday means stocks are going to rally. And at one point, the Nasdaq 100 up nearly 3%, the Russell 2000 2.5%, but the Nasdaq 100, the NDX finished up 2.5% for the day, the Russell 2000 2.11% for the day, the S&P 500 1.6%, the equal weight 1%, and the worst performing sector was actually bonds because yields rose on the back of that better than expected economic data. And while things may even look frothy with stocks at these levels, they are not really. This is US market valuation, the total market, and it's currently only overvalued by 2%. If you remove the three biggest stocks in the market, I think the market would probably be trading under fair value. So not a bad idea to actually pick up stocks in this environment, even though it may appear overvalued. If you look at something like the RSP or even some of these smaller cap indices like the CARF index, the MOAT index, you're probably buying stocks that are under fair value going into rate cuts, and that's normally what leads to outperformance. That's how you generate alpha. And today's market price action was bullish across the board except in bonds. The TLT was actually down 0.33%. The AGG was actually up here today, so it was just longer dated bonds, and that's because the 2-year yield did actually fall, but the 10-year and above did actually gain. So a bit of weird price action in bonds, but that has to just go with the yield curve being uninverted, and the market needs to price out some of the things Jerome Powell said and the way markets are moving right now. We saw the dollar did fall. That actually did support large caps, particularly towards the end of the day, and we saw gold and silver do what commodities do in rate cutting cycles, and that's absolutely rally along with crude. Silver up 2.43%, gold 1.1%, crude up 1.73%. Commodities really do benefit from easier monetary policy. But then across the equity curve, the S&P 500, the Nasdaq, the IWM, the Qs, the RSP, midcaps, the SP 600, growth and value all really outperformed today. They were really, equities was is the place you wanted to be in because they actually outperformed the commodity markets. I mean, look at the Nasdaq 100 up 2.56%, the S&P 500 up 1.7%, now above the 5,700, an official close above the 5,700, the first time ever. The advanced decline line also at new all-time highs, and the advanced decline line was signaling new all-time highs in the S&P 500, new closing highs for the better part of like 4 weeks now. That's a new all-time high. That's super bullish. And what we also saw in the gamma charts was everything moved up: the core resistance, the gamma flip, and the put support. However, the core resistance moved up a lot more than the gamma flip, meaning there's still a tiny bit of uncertainty under the hood, but maybe we see this move to 5,600 and then 5,650 over the next couple of days or into next week. Nonetheless, very limited upside to the 5,750 area. You still want to be long. And by the way, all these levels change in the pre-market, guys. So this right here is what the gamma chart would have looked like in the pre-market when the market opened at this point, you know. So these don't change dynamically during the day. It's at the pre-market once all of the options orders go through. But 5,750 now, the core resistance, a tiny bit of upside left to get to this level. We can maybe see that in tomorrow's trade. Things also looking sort of good in the after hours, but if we got a little bit of like just a little bit of a pullback, profit taking in tomorrow's trade, I wouldn't be surprised at all. Nonetheless, things are bullish and you do want to buy dips, and one of those dip areas is the 55.75 area. Let's say we do pull back, this is where I expect to find support, and then we can go from there. But do I think we're going to get there? I don't think so. I think the markets are on a little bit of a rally right now, and I think if we are to see downside, we're probably going to find support here, you know, at the 56.50 area, sort of around there, and then continue the move higher. The S&P 500 chart looks really good, especially on a year-to-date basis. The Nasdaq 100 looking really strong. This is the core resistance of the Nasdaq, so it's right here, and it actually did move up, but the gamma flip on the Nasdaq didn't move up at all. Very interesting. We'll see if that actually changes tomorrow. The IWM, let's actually look at the RTY. I prefer this. The gamma flip is at 2150. It moved up yesterday, not today, and still a little bit of upside to reach that core resistance on the gamma flip. However, we did go ahead and break this high, which means this right here is now officially confirmed as a higher low relative to this low, and this low. And all we need to do now is go ahead and close above this line, pretty much close above the core resistance at 2307, and that would be a new 52-week closing high. Very constructive. I mean, the RTY chart looks very constructive. I mean, this is just like higher lows, right? And then higher highs on the way up. We haven't broken this high, no we haven't, but we're making waves towards it. Actually a little bit upbeat here in extended hours, pretty much flat but green nonetheless, after a 2% rally off the open. Very strong rally in the IWM as well as the RSP. Very constructive. There's nothing I can really say about these. Every chart just looks the same right now. Looks good, looks strong, looks like it wants to go higher, and I think that's what's going to happen. And I really think in this market right now, you do just want to buy dips. Any pullbacks we do get in this volatile September-October period, you do want to buy those dips because we probably are going to go high into the end of the year as the Fed further cuts rates and as the economic data continues to come in good, because these rate cuts are going to spur on economic growth. And guys, and let's dive into some of the stocks that I've said to buy over the last couple of weeks. PayPal has been one of them, up 6% today, a new 52-week closing high, and it looks like it's going to continue. I think we see $80 in this name very soon, before the end of the year, maybe even 85, and I think we go see $120 into next year. Looking at the CAF index, strong performance right here, very constructive price action after making this triple bottom. We now just need to go ahead and break this high, and ultimately this high right here to confirm these lows, but we did go ahead and break this high. That's constructive, a close above, and now we just have to go and look to this 49.50 area right here in the CAF index. Very constructive. I'm very bullish on this stock right here, and small cap quality for the most part. Been a bit of a dumpster fire this year, but that's because it rallied like 35% last year. It beat the S&P 500 last year, and it was just giving some back with these small cap earning revisions, but very bullish long term. This index has returned like 14% compounded annually. Very strong returns. Looking at another name, Google, my most recent position in my portfolio, Google was up 1.15% today. I got in at about this level right here, and I think we're going to see these all-time highs for Google, but it's got a bit of roadblocks ahead. It needs to go and take out these highs first to confirm this as a higher low relative to this, and also just to break this lower low it formed relative to this low right here. Looking looking at another name, Paycom, probably the stock I'm most bullish on besides PayPal. A very strong performance here today, up 1.16%. And like Google, it just needs to go ahead, break this high right here and close above. Then we would just be looking at a low, higher low, higher low, and then a higher high. And then we can tackle some of these higher levels at the top right there. Looking at the MOAT index, MOAT from Van Eck, it looks like the RSP, although a little bit stronger at all-time highs. And you want to buy all dips. If we get to the 93 area, you want to buy those dips. Otherwise, dollar cost average into a name like this and hold for the next 10 years, you'll do very, very well. I like the construction of this index, the CAF index, QSML, QUAHL, and I also like the names PayPal, Paycom, Google. So if you guys are looking for stocks, I think all of those names, all of these ETFs are trading at a reasonable price relative to the growth they will exhibit over the next 12 months. And diving into sentiment, this is CNN's Fear and Greed Index, and we finally hit the greed zone. We're sitting at 57. Just last week, we were in the fear zone at 44, and 57 suggests investors are feeling optimistic and there's a moderate level of greed in the market. This can imply stocks are maybe overbought in the short term, but it's not an extreme situation. Markets are bullish and investors are actually more confident about taking risks, especially after getting that 50 basis point rate cut yesterday. And guys, for us to push into this extreme greed zone, markets will really need to rally. And the data does suggest that could happen. This is S&P 500 returns after a first Fed rate cut, 3 months, 6 months, 12 months thereafter. When we did get a recession, markets didn't do so well 12 months after. But when we avoided a recession, markets actually went on a double-digit mid-teens to mid-20s rally. You can see in 1998, the S&P 500 returned 23%, absolutely insane. In the year 1984, we returned 14%. That's well above the market average of about 9 to 10%. So in a cutting cycle, if we don't get a recession, guys, which I don't think we are, markets tend to do very, very well. And this is an analog from 2019, something I just thought we'd look at. It's the SPY performance after the Fed rate cuts, which coincides with the unemployment rate. So this blue line right here is the S&P 500. This green line is the unemployment rate. And you can see in 2019, the unemployment rate actually fell. This is when we got the last Fed rate cut. Now, the NFP data right before this last Fed rate cut saw the unemployment rate go from 4.3 to 4.2%. So we did see the unemployment rate fall. When we see that happen and we got a rate cut, equities tend to do very, very well as long as the unemployment rate continued to move down or remain stagnant. Stocks did very, very well. The S&P 500 in this instance returned about 15% in the year from the first rate cut. Very, very strong momentum. And if you want even further outsized returns, you want to look at something like mid-caps. Mid-caps typically outperform the S&P 500 and the Russell 2000 following the first Fed rate cut. Average returns 12 months later, 13%, 3 months later, 3%. So you really want to be in mid-caps because they outperform their counterparts, especially even if the market isn't going into a recession. And earnings are signaling that there is no pending recession in sight. Yes, we have seen the average AI ETF, their earnings have pulled back, but that probably has to do with more structural flows and the market and companies not really seeing the impact of AI spend just yet. Whereas the average S&P 500 company is actually seeing forward 12-month EPS growth year over year rise into September 2024. But at the end of the day, it all comes down to the macro, guys. We have to pay attention to the macro data we get over the next 6 months because it's so important. And this week's housing starts and retail sales data was a step in the right direction. Because of that, Goldman Sachs boosted their Q3 GDP tracking estimate to 3%. The Fed's GDP now tracking estimate sitting at roughly the same place as well. If we look at other economic indicators, stuff like rail traffic, things are looking rather robust. Basically, guys, when it comes to rail traffic, this just tells us that more goods are being moved across the country by rail, which is a signal for economic health. When rail traffic is strong, it typically means businesses are shipping more products, manufacturers are stocking up on supplies, and consumers consumers are buying more. For the economy, this uptick in rail traffic suggests we're seeing higher demand across multiple sectors. Strong rail traffic is typically a good precursor to strong GDP growth. And we could see total intermodal units versus 2023 up 13%, total traffic up 6.8%, very strong. And then year to date versus 2023, strong as well, up 9.5% and 3.3% in intermodal units and total traffic respectively. And this is on the back of coal being a complete dumpster fire. It has the biggest cumulative cart load out of all of these, and we've seen coal decline versus 2023 8.4% and 14.9% on a year-to-date basis, and we're still seeing very strong numbers right here. And that just goes to show the underlying demand in the economy. To be honest, I'm not seeing that recession just yet. You want to see these figures be a dumpster fire, and they actually look very healthy. At the same time, federal tax receipts very strong, and strong tax receipts mean businesses and individuals are paying more taxes, companies too, which signals healthy profits and income. This points to a robust economy, guys, with solid business activity and consumer spending, and the combo of solid tax revenue and inflation continuing to moderate. This is showing signs that the economy isn't overheating, and this right here is actually really good for the economy, up 6.1% through September, and we're not even done September. And tax receipts have been strong in August, July, June, May. The only negative month we've seen in the last 12 months, the trailing 12 months, is December 2023, which was negative 8.6%. Then we also saw a weak January, and ever since it's been very strong up until right now, with the daily average being 3.9% in federal tax receipts growth, way down by this figure right here in December. So I personally think, and all of these economic indicators, rail traffic, federal tax receipts, economic growth, the unemployment rate, all pointing to what is a pretty strong economy, even if the media says differently. But let's actually go ahead and talk about the FOMC's summary of economic projections. And we're actually going to look at the median right here. We're just going to zoom in, and the Fed see GDP trailing off at 2% in 2024, 25, 26, 27. The unemployment rate, they actually see the 4.4% level here at its peak, going down to the 4.2% level in 2027. PCE inflation, they see inflation continuing to moderate, as well as core from the 2.3% to the 2% range, and core from 2.6 to the 2% range. And they see the federal funds rate to moderate to 3% in 2027, and the longer run projection of about 2.9%, so pretty much 3%. So where we are right now, 475 to 5%, in this range right here, we still have about another 175 basis points worth of cuts to actually get to this level right here. But these economic projections right here is about the closest thing that you're going to get to a mission accomplished banner that you can imagine. I mean, 2% inflation with no slowdown in economic growth, and the unemployment rate staying low, 4.4, 4.3, 4.2%. That's rather robust. And to be honest, this GDP growth number looks very conservative given the productivity numbers we're actually seeing in the economy right now. So we could actually see this number take up closer to maybe 2.5, 2.6% in 2025-26. But strong projections, and in this type of environment, we just want to hold equities. It doesn't even matter which equities. All equities do well in this type of environment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.